have made most of my money with Bitcoin and with crypto. And so naturally, I'm wearing rose-colored glasses. Naturally, I have a positive bias. But in this video, I want to talk about the case against Bitcoin. What speaks against investing into BTC even in the long term? Because in the end, everybody has to ask themselves, is it worth the risk? Bitcoin can drop by 70 or 80%. Is the long-term outperformance really worth it? Because in the early days, it was not necessarily just about risk versus reward. In the early days, it was also about using Bitcoin as a diversifier in a broader portfolio. But that diversification effect has weakened over time. Have a look at this. At the bottom, we've got the Nasdaq 100. At the top, we've got Bitcoin. And this is the COVID crash. So when the stock market went down, Bitcoin went down even more. And when the stock market rebounded, Bitcoin followed. So there's a lot of correlation now. The two assets tend to move in the same direction at the same time. Bitcoin isn't necessarily that much of a diversifier anymore. And so that then leaves the big question. Is Bitcoin, as it stands today, in isolation, a good bet when we adjust the returns for the risk? Let's have a look at some relative valuation charts that most people haven't yet considered. Check out this long-term chart. This is the Bitcoin price relative to the Nasdaq 100. So how much does Bitcoin as a risk-on asset outperform technology stock? And in the first years of Bitcoin's history, we had a very clear outperformance. But have a look at this red circled area at the end of 2017. This is when Bitcoin hit $20,000. Now it's a multiple X higher than that, but it didn't outgrow the Nasdaq 100 that much. The outperformance is only 50% over the span of roughly 8 years. That outperformance comes at a price of temporary crashes of 84% over here or 71% over here, right? Relative to the Nasdaq 100. So we have to ask ourselves, right? Is it worth the risk to buy Bitcoin over the Nasdaq 100 when the outperformance over all of those years is comparatively slim, while the volatility is much higher, while it can crash much more? When we zoom into the recent past, so since Bitcoin hit 60K in 2021, we have seen zero outperformance. But again, we did see much more risk. We did have our major correction in 2021 and 2022. Let's compare Bitcoin to gold. Gold clearly being much less risky than Bitcoin. So we should see outperformance of Bitcoin versus gold. And yes, since 2017, we did have quite a bit of outperformance, almost 100%. But since gold is recently catching up again, since 2021, so in the last 4 to 5 years, when Bitcoin hit 60K, we have seen zero outperformance versus gold. While at the same time, we had all of that additional volatility, our 75% drop over here. And so there's an argument to be made that the performance that we got in the last 4 to 5 years was not high enough to justify all of that risk. We got similar performance with much less risky, much less volatile asset. Now, when we're looking at this data, we regard volatility as a bad thing, as in the more the price is going up and down, the worse it is. It is better to have very high return with very little volatility, not so many shakeouts, right? The idea is that we simply just buy and hold and we want to get consistent gains. Some people regard volatility as a positive thing. If you think that an asset will survive over the long term, that it will grow long term, then volatility might actually be an opportunity. Then we might be able to buy at very low prices when the price is going up and down very violently. But that's then an argument for timing the market, not necessarily an argument to buy and hold Bitcoin over the long term. Now, we've got over here, that's Bitcoin relative to the US money supply. Bitcoin had been created at the peak of the global financial crisis when the money supply was expanded massively. And yes, we still see Bitcoin outperforming monetary debasement. So it's still fulfilling its base use case, even though we could argue that a lot of the growth caused by adoption of the asset has already been realized. So there seems to be something special about the peak in 2018 or the peak in 2021, because since then Bitcoin wasn't able to outperform that quickly anymore. Something else also happened during that time. Have a look at the number of active addresses on the Bitcoin network. We had very constant growth up until 2018. We hit a slightly higher level in 2021, but really the growth of the network in terms of activity has stopped in 2018. And that's maybe one of the contributing factors why Bitcoin just gets traded as another risk-on asset without much more long-term outperformance, potentially. Now we're going to look at the arguments pro Bitcoin in a minute, but I simply just want to show those charts that somebody that is not invested at all in this space might see those crashes, might see this relative performance and then say, maybe the risk isn't really worth it. If I can get the same performance as technology stock, at least over the course of the last 4.5 years, and if I also cannot outperform even the gold performance being invested in such a volatile asset, maybe risk-adjusted Bitcoin isn't the best proposition in isolation. And it's also not the best diversifier, as we've already talked about at the beginning of this video. Now let's continue with this line of thought. Let's assume that Bitcoin will simply just slightly beat monetary debasement, right, the 6.8% per annum, that it might still beat gold, it might still beat technology stocks, but the growth rates won't be as high as most people currently think. If Bitcoin has just become yet another risk-on asset without that much more adoption growth, then really the chances of outperformance are just in timing the market. So then it's all about using the volatility in our favor. It's all about buying when the price is very depressed. For example, when the current price is below the average cost basis of the market. Historically, this was always the best time to buy. When the average Bitcoin investor was in losses, the market is at maximum depression, and that's when we want to get in. And there is still a case to be made that even though Bitcoin might not outperform traditional risk-on assets anymore long-term, that it's still a great buy whenever most people give up. Currently, the realized price is at 55K, unfortunately. There's still a lot of way to go down until we've got a buying opportunity that can give us the multiple X returns. Bitcoin is clearly maturing and it does see consistent inflows into the market now through Wall Street as well. We've got the Bitcoin treasury companies that's shown over here. And on top of that, we've also got the ETFs. Both entities tend to buy consistently. And that, of course, helps the asset. But we've got similar kind of buying pressure also for risk-on assets, right? People investing into 401ks, they tend to buy QQQ or VOO. So the stock market also has continued purchases through retirement accounts. Currently, 3.36% of Bitcoin supply gets purchased every year through the ETFs. And then we've got also the purchases through the treasury companies. So probably around 7 to 8% per annum gets purchased through Wall Street. So that's currently the acquisition rate, which should push up the price. On top of that, we've also got Bitcoin that gets lost. So even though we didn't see that much outperformance since the beginning of 2018 relative to the Nasdaq 100, we have seen roughly 12% of Bitcoin supply not moving anymore, right? So this is the percent of Bitcoin that hasn't moved for the last 5 years. So this also tends to go up in aggregate. It's not just the purchases through Wall Street, but also the lost Bitcoin that shrinks the liquid supply over time. The Bitcoin network might not grow that much anymore in terms of activity, but it's clearly an asset that becomes more and more rare over time. The Bitcoin mining rate is, of course, much slower than the acquisition rate through Wall Street. Bitcoin mining expands the supply by 0.84% per annum. So roughly 1/10 of what we see through the ETF plus treasury company demand. So at a minimum, we should see Bitcoin appreciate at the rate of the monetary expansion, which is on average 6.8% over the last 77 years. This is a quite constant growth rate. But there's a reason to believe that we will see even quicker growth because of the supply contraction. What we're seeing here is the Nasdaq 100 relative to US M2. So technology stocks are able to outpace monetary expansion. They are actually creating purchasing power increases. Since 1985, technology stocks have outperformed the monetary expansion by more than 2,000%. And I believe that Bitcoin will at least outperform at a similar rate. The only question is, what are the very early adopters doing? The people that bought Bitcoin in the early days for a few hundred, maybe for a few $1,000s, that now continue to take profit as the price is going up. Because if this chart here, Bitcoin relative to the monetary expansion, is any indication of what's going to happen long term, so Bitcoin only grows slightly more than the monetary debasement, then very likely crashes like this of more than 70% will still prevail. We might see even 80 or 90% crashes again. Because have a look at the gold price relative to the monetary base. This is now a chart of a much longer time frame. This starts in 1959. And we can see that gold is able to withstand monetary debasement as well. It might even long-term outperform. We don't know how much gold is going to retrace from the current heightened levels. The dotted line, by the way, is the average ratio of the gold price relative to the monetary base. But we can see that gold can crash by 60%, or in the worst case, by 90% versus the monetary base. Gold just grows at the rate of the expansion of the monetary base. And so if Bitcoin will do the same, we might see similar kinds of contractions. The reason why we quote unquote only see 70% corrections, not 90% corrections, is because Bitcoin still grows faster than the monetary base on a macro scale. But if that growth halts, if Bitcoin just keeps pace with monetary expansion, then volatility like this over the decades is definitely on the cards as well. Even gold did this, so why wouldn't Bitcoin? So when we look at the performance in the last 4 to 5 years relative to other assets, when we look at the volatility relative to other assets, what does this imply for our investment strategy? The first implication is that yes, when Bitcoin gets depressed, it makes sense to be more allocated. But the second implication is that maybe sometimes we should also be diversified with things that are not that correlated to Bitcoin. Stocks, unfortunately, do have quite a bit of correlation, but gold might not. And so maybe we can use indicators like this, the CBBI. When this is very high, Bitcoin tends to be extremely elevated. When this is very low, Bitcoin is very cheap, historically speaking. This, by the way, is a composite index of all kinds of indicators, but it seems to be trading in a relatively reliable range. And so based on that indicator, we should rather have a lot of money in other assets now, not just in Bitcoin, but also in property, also in gold, also in anything that doesn't move with the Bitcoin price. So imagine this indicator gives a reference of how much to be outside of Bitcoin. When this is at 100, you want to be completely out of Bitcoin. When this is at 0, you want to be 100% in Bitcoin. And so you can simply just adjust the weightings of your trading portfolio based on that indicator. That's one potential approach among many. If your time horizon is very long, so you're looking at 10, 20, 30 years, and you don't care at all that Bitcoin crashes by 70 or 80% in the meantime, you can simply just set and forget. Bitcoin is likely going to continue to outperform monetary debasement. But if your time horizon is shorter, then maybe it makes sense to adjust expectations. We really don't know if Bitcoin will continue to outperform other risk-on assets. It has not done so for the last 4 to 5 years, and even the outperformance over the last 8 years relative to the Nasdaq 100 was very slim, only 5 to 6 percentage points per annum. That's not that much given the massive volatility, right? We could create a better risk-adjusted return just by levering up the Nasdaq 100 with 2x. A 2x leverage on the Nasdaq 100 would have given us more return while less downside risk. So really, if we don't see a massive rally in the Bitcoin price to 200, 300K in the next year or two, then this thesis here prevails, that Bitcoin's long-term growth isn't that high and that we should mainly take advantage of the volatility and buy the massive crashes. Now, there are different ways to interpret the current market situation. What we see over here is a long-term chart of the stablecoin market cap. This starts in 2022. We had the Terra Luna collapse over here, where then the market tended to shrink until October of 2023. So the stablecoin market cap went down by 27%. But since then, this chart is going up. Now, when the stablecoin market cap is going up, that means people are moving their funds from the fiat ecosystem, from traditional finance, into crypto. People are sending their hard-earned cash, say, to Binance. Binance sends this over to a stablecoin custodian. The stablecoin custodian is buying bonds. The stablecoin custodian is making money via interest. issues the stablecoins, and the stablecoin issuance can be seen in this chart. So whenever this is going up, money is getting into the space. And that means crypto prices should, as per tendency, rather go up. How much should they go up? Have a look at this here. In red, we see the crypto market cap except the stablecoins. So all the cryptos, Bitcoin, Ethereum, and all these smaller cryptocurrencies. And of course, they tended to go up since the stablecoin market cap increased, but they went up more, right? 270%, while the stablecoin market cap went up only by 130%. But there is a catch here. I don't necessarily think that most cryptocurrencies will grow faster than the stablecoin market cap. Because here's the thing, there's not just the stablecoin market cap, there's also the degree to how much those stablecoins are getting deployed. Some people might just transfer their stablecoins to Binance, hold that in their wallet, and then wait for a while until they actually buy altcoins with it. The trading from stablecoins into risk on volatile cryptos and from volatile cryptos back into risk of stablecoins, that's actually what causes the short-term fluctuations in the market. Because obviously the stablecoin market cap is going up much more smoothly than the prices. And that is because of stablecoin deployment. Now this here is the stablecoin dominance, and it trades between 5% and 9% of all of crypto. Have a look at this yellow circle here. This is when the stablecoin market cap tended to turn around, when there's more money flowing into the system. So from that point to today, we have seen the stablecoin dominance go down. So the market as a whole got more risk on. There's less dry powder on the side now than there used to be in October of 2023. When we actually compare 2 points where the stablecoin dominance was very equal, then we are getting a different picture. So this red circle over here is the same time with that red circle over here. And so the stablecoin market cap went up by 128% since the beginning of 2024, while the stablecoin market cap went up by 115%. So the growth rates are extremely similar. When the stablecoin market cap goes up by 10%, then crypto prices on average should also go up by 10%, maybe slightly more. But there might as well be zero difference if we just come a little bit more down in the crypto market cap. So really, the two growth rates are very similar. We have to work with how quickly the stablecoin market cap is expanding. And so how quickly is it expanding? In the last 12 months, it went up by 65%. In other words, if we don't see any systemic implosion, if we don't see something like the FTX collapse or the Terra Luna implosion, if the market continues to expand, then we should work with a growth rate of 64-65% per annum from here across all of crypto. That's how fast the stablecoin market cap is going up, and it's doing that expansion at a quiet, consistent rate. Now then we have to wonder, if we are in a bull market since October of 2023 and we are expanding at roughly 65% per annum, does this also mean that it warrants to get more risk on, to potentially buy more altcoins and potentially sell Bitcoin? Let's have a look at the altcoin performance since October of 2023 relative to Bitcoin. This point in time over here, this circle equates to this point in time over here. This is now total 3 ES, so the altcoin market cap minus the stablecoins relative to Bitcoin. So how did the altcoin market cap do relative to Bitcoin? And it actually went down. Bitcoin outperformed during this expansionary period. The altcoin market cap went down by 17%. The problem is that this chart is even underrepresenting of how bad the altcoins did. This here is much more representative. Remember, the stablecoin market cap went up by 65% in the last year. This is the performance of the smaller altcoins in the last year. Most of them went down. They did not on average appreciate by 65% or maybe a bit less than that, let's say 50%, because of this underperformance. The price performance seems to be much, much worse. And the reason for that underperformance is token unlocks. So early investors and the team and insiders, consultants, etc., they get token allocations over time. They get vesting periods and they can then sell those tokens. There are various pages describing the situation. This is coinmarketcap.com/token unlocks. We can see how there are several unlocks across many different cryptocurrencies. So let's say a cryptocurrency is at 1 million tokens, and then come all of those vesting unlocks. All the insiders get access to newly minted tokens. The supply goes from 1 million to 2 million. Then maybe the price gets cut in half, but the supply has doubled. The market cap of that altcoin is unchanged. But everybody that bought the altcoin, they lost 50%. So the insiders dump on the retail investors. And that effect is not seen in market cap comparisons. That's why we cannot use the others dominance or the total 3 dominance or even the Bitcoin dominance. The Bitcoin dominance should be much higher, as in if we just compare prices, not necessarily market caps. Let's have a look at a few of those altcoins here. Minus 99.5% over here, minus 99.9% over here. This went up initially, but from the top of 30 cents, this also crashed massively to 2 cents, because probably that's when the people started to sell. Then we've got here minus 56%, or over here minus 61%, ApeCoin. And this is much more in line with this picture over here, right? Charts like this. Let's actually have a look at ApeCoin in a bit more detail. This is the number of circulating ApeCoin over time. We started at 284 million and now went up all the way to 940 million. So the supply more than 3x'd. And who got those tokens? Again, it's the insiders that dump on the project. They take the money. And so the straightforward approach would just be to bet on falling prices of most altcoins, especially on the altcoins that tend to have a rising supply. So when ApeCoin goes down, let's just bet on falling prices and get this return instead. The problem is that we do have a lot of volatility here. This is a crash of 74%. So betting on falling prices can also be a problem if there is positive news and we see a temporary rally in the price. But we can mute this risk somewhat. Because one of the reasons why sometimes those short positions can also be dangerous is because the market as a whole might go up. When Bitcoin goes up, when Ethereum goes up, then most altcoins go up as well. So really what we are interested in is the ApeCoin performance relative to Bitcoin. This is now Bitcoin divided by ApeCoin. And this is much less volatile. This only dropped by a bit over 50%. Have a look at the volatility of this chart versus this chart. Isn't it much better to invest in this instead of into this? All of those drops here were just the market itself going up. It was not ApeCoin doing particularly well. This, by the way, is a logarithmic scale. On a linear scale, this looks much more juicy. This is how we make money in crypto. And this is a very uncommon approach, right? Most people, they try to find the next hidden gem. They buy an altcoin portfolio. They have maybe 10, 20 altcoins. Try to find the next thing that does another 10 or 100x. But I don't think that's the best way to go about this. Do you really want to find a winner in a market that looks like this? Do you really want to scan the market and find the next wallet token that makes 53%, where at the same time Bitcoin doubled? I don't think so. I think it's much better to turn everything that's red on this chart to green and everything that's green on this chart, which isn't much, into red. I'm following this approach already for the last 4 years, and had I just dollar cost average into Bitcoin, I would have gotten the performance here in light gray. But because I also bet on falling altcoin prices, I got the performance here in black. It's a constant outperformance. It's not about finding the next 100x luck shot. And so I'm talking about the strategy in more detail in the premium membership of this channel. Here are a few trades that our members have shared that shorted various altcoins with high token inflation. And I made several videos on the topic as well. Now you don't have to watch everything over here. There's only 2 very important videos using perpetual futures to bet on relative valuations and risk management with relative valuation bets. Risk management is extremely important. Here's the first video, it's 34 minutes. Here's the second video, it's 28 minutes. And the reason why I say risk management is so important is because there is a lot of volatility within the perpetual futures market as well. And if you don't know how to handle leverage properly, if you don't know how to do proper position sizing, then you will lose your funds. You will not make this kind of returns. The recent shakeout in the market actually helped us. It was one of the best weeks we've ever had. We made 10% on our copy trading capital pool. Now, once you've joined Premium and you've watched the 2 videos, I will share my favorite trade with you. It's something like Altcoin, but better. If you don't make money with that trade when holding it for 1 month, then I will refund the membership fee for you. So really, you're not risking that money. You're not risking the 125 US dollars. If you're not making money with the trade that I'm sharing, I'll just send that money back. No questions asked. Now, I've talked about this trading pool over here. This was a project launched in July of this year. Again, where we were following relative valuation trades. Everybody that got in this is already up 19%, where at the same time, Bitcoin lost 9%. Now, unfortunately, this capital pool is already closed. But if you're part of the annual members, you will get access to the next pool in January of next year. Feel free to check out the tutorial video of the last trading pool. Again, it's an approach to bet on charts like this without having to execute the trades yourself. I simply just trade for you. I'm of course sharing all my trades to every member. But if you want to become part of this project, then you can also consider joining up for the annual membership. So that's over here. You're also saving $250 per year doing so. But you can simply start off with the monthly membership and then switch over to yearly afterwards. A link to Premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.